right. Good morning. Good morning. Good morning. Today we are going to be day trading again. That's what we do on this channel is we like to look at intraday trades, whether that's with options or whether that's with individual contracts, shares, however you like to trade. We like to trade intraday. All right. 0 days till expiration options. And we like to scalp and day trade the financial markets. And today I'm going to show you how to scalp and trail with a small account. And one of the great things about trading in the futures market over in Chicago, and rather than in New York, is that we don't have pattern day trading rules. And a lot of people, believe it or not, don't know that you can trade somewhere other than New York. I know it's kind of a new concept for some people to think, hey, what? You can day trade somewhere other than New York City? Yes, there are exchanges that are not just in New York. It's just the New York exchanges that have pattern day trading rules. There's lots of places you can trade in this world, and one of them is in Chicago. And another thing a lot of people didn't know. Now, I know those of you who are regulars at this class, you know that the reason we have the sports teams called the Bulls and the Bears, they're in Chicago for a reason. What do you have in New York? You have the Mets, the Yankees, the Mets and the Yankees. Yeah, that's what you have in New York. So if you want to be a Yankee, go over there and trade over there with pattern day trading rules. But if you want to be a bull or a bear, Bulls and Bears, get it? The basketball team, the Bulls, the Bears, the football team, you get it? They're out of Chicago for a reason because we have exchanges there that you can trade on. A lot of people, when I tell them that they don't make that connection until they make that connection. I do that at the university when I teach at the university. And you watch the classroom light up. It's like the first time they ever put that connection together. Oh my gosh, the Bulls and Bears. That's like trading, isn't it? Yet those are sports teams, and they're in Chicago. They're not in New York. That's because we trade in Chicago. All right. There's no pattern day trading rules if you're going to trade in Chicago. You can trade with a small account, and you can trade lots of different things. Now, you can't trade Apple, and you can't trade, Meta, or you can't trade, all the individual stocks. But that's okay. Hey, you're day trading. All you want is a market that's going to go up and down. That's it. It's a game you're playing. We're not investing. We're trading. And so all we need is a market that moves up and down. And we don't care whether it's Apple or Meta stock or Tesla or whatever. Who cares? You just want a market that moves up and down. And over in the futures market, which is what it is, the Futures Exchange, Chicago Board of Trade, and Chicago Mercantile Exchange, out of Chicago, well, those markets move up and down. And that's all you really need. You just need a market that moves up and down. Now, you need to have a special piece of software to access the Chicago markets, but it's not a big deal. There's a couple of really good software programs out there. And the one I'm using, the one I like to use, if you're going to trade in Chicago and not have any pattern day trading rules, is I like to use a program called Track and Trade. And that's what you see up on the screen right now. And I got a little link for you. There you go. If you scan that code, that'll take you over there with your phone. Now, of course, that's going to take you over there on your cell phone, and you can't install Track and Trade on your cell phone because it's not an app. It's an actual trading platform. So if you're going to come and trade with the big boys, with the Bulls and the Bears, you need to pull on your big boy pants, and you need to get some real software. All right. You're not going to do this on your cell phone. So this is not the kind of trading that you do on your cell phone. Put on some big boy pants, go get you a computer if you don't have one, and install this software right here. It's called Track and Trade Live. Go to trackandtrade.com, download it, install it on your desktop, and actually sit down at your desk and do some trading. All right. That's how you do this. Now, don't come over here into the Chicago markets and think you're going to do it on your cell phone because you're going to get your hiney handed to you. All right. This is where the big boys trade. All right. So come and join the big boys. Now, the big boys have set this up so that little boys can come and trade too. We have micro accounts, small accounts. So you can open up your account with as little as $2,000 and start day trading to your heart's content. You can trade 1,000 times a day. Again, there's no pattern day trading rules. You can go long and short just as easy. There's no easy to borrow. There's no worrying about paying interest rates on the money that you borrow. There's no worrying about having to pay the dividends if they pay dividends while you have a short position. There's none of that. We don't have to deal with any of that in the Chicago markets. All right. So all you have to do is just have a special piece of software that'll connect to them. And it's real easy. You just install it on your computer, open up a little account. You can open up with as little as $2,000, trade the micro accounts, open up as little as $5,000 and trade the mini accounts. Now, these are the mini accounts that we're looking at on the screen right now. These are just 4 different views of the same market. Now, this is the Dow. Now, what do we trade in Chicago? When we trade in Chicago, we have the 4 indexes, plus we have all kinds of fun things. The reason we call it the commodities market is you can trade things like crude oil, you can trade natural gas, you can trade pork bellies. Actually, we can't trade pork bellies anymore. They took those off. But you can trade orange juice and cotton. You can trade all kinds of fun things. All right, silver and gold. You can trade unleaded gasoline. You can trade hogs. Might not be able to trade pork bellies, which is bacon, right? But you can trade live hogs. You can trade cattle. You can trade, all kinds of fun things. Corn, wheat, soybeans. There's all kinds of fun things you can trade. But as traders, we don't really care. All we want is a market that's moving, right? We just want something that's going up or down. We just don't want sideways markets. That's the one that kills us. So we just like to trade in the mornings because that's when markets have a tendency to run a little bit stronger than other times. Sometimes they run a little bit too strong. And we have to be careful of that too, because markets can sometimes whip all over, like that 2-minute Dow right there. Shot all over the place. That's not a fun market to trade. But we broke it down up here, up in the upper right-hand corner. We've broken it down into what we call the range bar chart. So this is a range bar chart up here. Give me 1 second. I got to drink some tea. It's my morning tea session, so hold on. All right, so these are range bar charts. Up here in the upper left-hand corner, this is a range bar 12. So the bars are twice as big as the one over here on range bar 6. And then down in the bottom left is a 15-minute chart, so you can see the longer-term trend. And then we see that this is the 2-minute chart down here in the bottom right corner. So we're get different time frames. We're looking at the same market. It's all the same market. We're just looking at them on different time frames. So if I place an order, you're going to see the order going to show up on all 4 charts. All right, that's how we're looking at this. Now, sometimes we like to look at the S&P 500. We like to look at the Dow, the Russell 2000, and the NASDAQ. And so those of you who haven't been following me, and this is your first day watching this class, you'll go back and look at some of the previous classes. We look at all 4 markets. We like to watch all 4 markets because they act almost like indicators to each other. One will take off and run, and then the others will follow. And that's a nice way to trade too. But right now we're just looking at the Dow, and I want to just kind of give you some examples of how you can trade some of these markets. So we use special charts. Again, if I turn off this HA button up here, this is called Heiken Ashi. Many of you have heard of Heiken Ashi. Some of you have not. If we turn off the Heiken Ashi bars, this is what your chart looks like without Heiken Ashi. And so you're like, oh, that's not as easy to trade. That's true. It's not. But this is also just a straight up range bar chart. I'm losing my voice. Hold on. And so these are just straight up range bar charts. All right. So what you see, that blue line across there is just your VWAP. That's your volume weighted average price. And then down here on the bottom, all we have is just volume. This is just your volume bars. And so, and then the overlay that you're seeing here with all the little arrows, that's the average true range. It's just the average true range of the market. Okay. So if it's above the average true range, we generally consider it to be bullish. If it's below the average true range, we generally consider it to be bearish. Now I've got the average true range to set very aggressive. And the reason I have it set so aggressively is because I like to use the Heiken Ashi bars. And so if we use Heiken Ashi, it puts a mathematical model over the top of the bars themselves, gives them a smoothing component. And so when you do a Heiken Ashi bar in combination with a range bar, which you can do in the track and trade software, it gives you this view of the chart. And it's really nice. It makes it somewhat easier to trade. Trading is never easy, all right? But it's not hard either. It's not like we're out digging post holes in the hot sun. We just have to sit here and wait for the right setup, the right pattern, the right opportunity. Now, let me tell you something. Look at this. This market's taken off and running. Now, if we'd have got in on that arrow right there, just that little arrow, or let's say this little red pullback, this is called a flag formation. We look for these. These are kind of things we wait for. And so you see the arrow with a couple of bars up, then you get a little flag formation, and then we anticipate a continuation of the bar up. So that was actually a perfect setup right there. And so we're going to draw a dollar calculator. I'm going to show you how much money that would have been. If you'd have got in just right here on the first candle to break a new high, right there, up until it crossed that yellow dot, which is where we'd get out, that was $100. How much time was that? That was about 2 minutes. All right. That's that 2-minute bar right down there. Those two, maybe 4 minutes. Okay. So in 4 minutes, you could have made $90. And how much money would you have had to invest to make that $90? Well, if you come over here to the key in track and trade, it'll tell you right here, the day margin on peak, which is what we are between 6:45 a.m. and 2:30 p.m., is $750. So you'd only have to put $750 into the account and trade one contract. Now we do contracts over here, not shares. And one contract, you have to have $750. Now, if we'd have got in right here at this little break right here, okay, and rode that up right now from here to here, that's $100. Again, you'd had to have $750 in your account to take that trade. Not like the stock market where you need like $25,000 just to put the trade on, and then probably, $25,000 and put the entire $25,000 into the market to make that $100. You'd have probably, it's a big difference because we have leverage over here. This is called a hedging market. And so it's designed to hedge your stock accounts, but we don't do that. I mean, you can, and I teach it, and I'll show you how to do that. But mostly what we do is we just use the leverage to day trade with. All right, and they let us do that. They don't mind. They're like, oh, you want to do that? Go ahead. I don't care. Do what you want. It's the last bastion of true capitalism on earth today. You hear me say that all the time, right? Took that from the movie Trading Places. If you haven't seen that movie, you should go watch that movie. It's a great movie about the futures market, right? Called Trading Places. It's got Eddie Murphy in it. It's one of his first movies. Funnier than heck. It's got Dan Aykroyd in it too. They're a really great team. So this is kind of where we come in and we just start drawing lines, right? We draw lines. So let's keep it simple. All I've got on here is one indicator. It's the ATR. Well, actually two, because I got Heiken Ashi turned on, and that's kind of an indicator. So then you just draw your trend lines. There's one up for every down. The problem with being one up for every down is we just don't know how long the one up is going to be or the one down is going to be. Markets can only do three things, right? They can go up, they can go down, and they can go sideways. So I've got a little diagram for that. Markets can only do up, down, or sideways. Now we have to pick one. When we're day trading, we have to say, well, I think the market's going to go up. Well, if you think the market's going to go up, it's got two other things it can do. It can go sideways and it can go down. So you've got a 33% chance of being right anytime you decide what you think the market's going to do. Now, when we trade like this, we're not going to pick sideways. We don't want the market to go sideways. We're going to stay out of the market if it starts to go sideways. And that's the hard part of trading. All right. If the market goes up and you picked up, well, that's easy. The market goes and you just get in the market and you just wait until it stops going up. Well, same with down. We can go down here in this market just as easily as we can go up. They let us sell first and buy back low later. The only way you make money is to buy low, sell high. But in the futures market, they let you sell first and buy back low later. And you say, how can you sell something you don't own? Don't worry about it. They just let you do it. All right. We'll get into that later. Just do it. You can. So you can sell something you don't have and you can buy it back low later. And there's no penalties. There's no fees. There's no borrowing. There's no interest. There's no nothing. You just do it. All right. They just let you. So just think of that. You can sell first and buy back low later. That's how you make money when the market goes down. Look at this market. It's taking off and going to the moon. All right. So here's another run right here. If we'd have got in on this little, just on that arrow, let's say we got in on that arrow to there. That's $145. $145 with a $750 investment. All right. So all you have to do as a trader is draw your trend lines, one up for every down, and decide which direction it's going to go. Up, down, up, down, up, down. We have counter trends, which in this case are the red moves. All right. Those are your counter trends. So we don't want to trade counter trends. Well, holy cow, look at this market go. Even that 15-minute chart is straight up. This is crazy. Lan, why aren't you in there? I am in here. I'm in here showing you guys how to do this. So you can do it too. Again, who cares? Is this Microsoft? No. Is it Apple? No. Is it Tesla? No. Who gives a crap? I don't care if it's Apple, Tesla, Microsoft, or the Dow. It's moving. It can make money, and you don't have to have a whole lot in here, and you can day trade to your heart's content, and you don't have to have $25,000 to open an account, and you don't have to do any of that crap you have to do over in the stock market. Why are you trading in the stock market? Because I want to trade Microsoft. Who cares? Who cares? You want to trade something that moves. You want to trade a market that moves and doesn't have pattern day trading rules. Just come and do it over here if you want to do it. I mean, if you don't want to day trade, don't do it. I mean, you know, if you don't want to do it. I mean, if you do want to do it, I assume the reason you're here is because you want to do this. But holy cow, smoke-a-roonies, look at this. From here to here. That's a $300 move so far. If you go all the way to the peak, that's a $300, almost a $400 move with a $750. What in the heck is going on? All right, we have to go look at the news. Did something take off today? Why is the Dow on fire? Retail sales. The actual retail sales were not even good. Let's go. Hold on, I'll pull this up for you. Impact 2. Retail sales. 6:30 this morning, retail sales. Forecast was 0.2. They only came in at 0.1. That's not anything special. Retail sales, automobiles. Forecast to be 0.1. Consensus was 0.2, and they were down 0.1. That's bad news. Industrial production. 0.2. Oh, it was up big. Forecast 2. That was at 7:15. 0.3. Actual was 0.9. So that was really good. Industrial production was up big. 8 o'clock, we got business inventories, and then the Fed speaks all day today. But man alive. Okay, that thing's getting ready to dump. All right, is it going to come flushing all the way back down? Probably. So you could take a short position right here and make money on the way down. Why aren't you doing it, Lan? Because I'm talking to you. If I was concentrating, oh my gosh, look at that thing go. If we took that arrow down, just trade the arrows, Lan. Just trade the arrows. That's $200 right there. 250, 260, 280. Look at that. Holy cow, $255 from the arrow. $265. That's with a $750 investment. That's all you have to put in here to make that $240. Take a short position. Again, you can sell first and buy back low later. They let you do that. Okay. We're just day trading, so you don't have to worry about taking delivery or making delivery or getting closed out or whatever. You just get out in a couple minutes. You're going to only stay in here one day, so you can do it. Just do it. Take a short position if you want. So all we have to do is just have to be right? Markets can only do 3 things. They can go up, down, and sideways. All you have to do is choose a direction and realize that you're going to be wrong 66% of the time. All right. If you put that in your head and you're like, I'm going to get in and I'm going to be wrong 66% of the time, but I have to be right more often than I'm wrong. When I'm right, I have to stay in and make money as long as it stays my color, red or green, right? You're going to pick red or green. Okay. Just kind of think of it like that. I'm going to pick red or green. If it goes green, I'm going to get in. If it doesn't continue and stay green, then just get right back out. Okay. If it goes red, then get back out. But as long as it stays red, stay in. If it goes green and it only goes green's 3 bars, well, didn't make very much money. Didn't give you a chance to move your stop to break even, and it turns red. Well, you're going to get stopped out with a small loss. So all you have to do is just pick the right direction, and you're going to be wrong 66% of the time. So the name of the game is cut your losers short, let your winners run. If you're wrong, just admit it and get out. Don't just stay in there and say, well, I'm going to stay in here and I'll just wait for it to turn around. Well, the problem with that idea is that the market can move $320 against you while you're sitting there going, I'm just going to wait. Okay, so don't do that because this is a big market. You only put $750 in and you lost $320 sitting there waiting for it to turn around. Don't do that. All right, just get out if you're wrong. Admit it. Now the market's going sideways. Look, I told you markets can do 3 things. They can go up, whoop, they can go down, and then they can go sideways. And it's when they go sideways that you keep trying to get in and out, in and out, in and out, in and out. You get cut with a whole bunch of small, it's like cut with death by a million cuts. And you have to be very careful. So what we have to do is we have to us as traders, our only job is to determine when the market's going to rise, fall, or go sideways. And the hardest part of trading is not staying in and trying to pick direction when it's going sideways. We have to kind of have an idea of when the market's going to stop going up or down and not sit there and go back and forth, back and forth, back and forth a million times, losing all of our money trying to decide it's going to go in. We wait for it to start to move in the first place. Once it starts to move, it gives us those little moves like this. See how it comes in here? The market starts to move like this, up it goes, and then it gives you the little pullback like that. And then once it starts to go again, that's where you want to get in. That's your move. Anytime you get that little rally, so see the market goes sideways, 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 and then it starts to move. Nice 3 bars, it gives you a little pullback. Then it goes green again. That's where you get in. Okay. That's called an ABC or a 1, 2, 3 pattern. Here it is again. Starts to go up, wait for it to go up, goes up, and then it gives you a little bar, and then the first green bar to make a new high, boom, that's where you get in. It did it again, made a little green, a little red, starts to go back up, and it went all the way up to this one. Little red, little green. This one failed, started to go sideways, came down. Then it went up. That's where you get in. Not here, not here. Don't get in here. Comes up here, and then it comes down, makes a little red. First green candle, make a new high. But you only want to do that after the market starts to run already. All right. And you can do the same thing to the downside. If the market comes down, you can come down. So it's coming down, gives you a little green, and then the next red, you anticipate a fall. Now, this time it didn't. Okay. It started to go sideways. So what you do is you just wait till you get into good move. Now, there's a pretty good move right there, isn't it? So if it gives us a couple little green bars right here, then the first red candle will anticipate it going down again. Now, sometimes it can just dump. It can just go like that, and you miss it. You go like, oh, crap. Went too far too fast. Now, okay, now it's coming. It's starting to go back up again. So if it turns around and makes a red candle to the downside, you can take it. But if it turns and just starts to go green and makes a whole bunch of green bars, well, you didn't get in because you're waiting for a red bar. So then you could turn and take the green bar. But it's just kind of going sideways right now. But we could take it. We could come in here and we could say, okay, it's made red bars after. We're going to take a short position, see if it wants to fall right here. Now we're going to put in our stop real close right in here. We're just going to drop a stop right up here. And if it doesn't go, we're just going to get right back out again, okay? We want it to fall far enough to, and then see those little yellow dots? That's why they're on there. I can come in here and I can sell it to, just follow those little yellow dots down. And if it starts to fall, those little yellow dots will just follow and trail down. But if it comes back and crosses the little yellow dots, see that? We just get out. So it didn't fall. It didn't move in our favor like we were hoping. So we just got out. Now we lost money there. We lost $30. You can see right there. Land just lost $30. But the market's not moving. It stopped going up and down. So we'll wait for a minute. Let's wait for it to start going up and down again first. We want to get a nice little run. You're going to feel like you missed it. It's going to go and you're going to go, oh, crap, I missed it. But that's okay because you want it to go. And then it'll make a little tiny pullback, a couple red bars, and then it'll take off again. All right. And that's what we're looking for. So here we go. It looks like it's starting to go. Let's wait for a couple red bars. There we go. There's one. Didn't break the yellow dots. Let's see if you're going to give it a little bit better pullback. There it is. Now is it going to go and start making green ones again? We can come in here and drop an order in here. I got these programmed in. Set up little settings so that it'll automatically catch it if it turns around and starts going back up. This is called scalp and trail. All right. So we're going to put a scalp in there and a trail just in case it wants to go a little farther than our scalp. Well, that's going the wrong way. So we're going to hit exit. We don't want to go long if it's doing this, right? Too much long, too much short side. Just take the arrows, Land. Just take the arrows. Okay, well, we could do that, but I thought we were going to take a little upside here. Now it's coming down like this. Now we'll get a little green. Maybe it'll come down again. Or it might just turn and go straight up. Again, we've only got a 66% chance of being right. Okay, so we're going to drop one in here. Drop another one in there. It might just be in a little snaky pattern here and not a continuation of a trend. If that's the case, we just probably miss each one. It won't move far enough for us to get in and go on a trend. So we're looking for it to drop again, but if it starts to go back up too far, we'll just get back out without placing an order. I got my text on the wrong side. I got it flipped over here to the left side. That text tells me what each one of those are doing. I got 2 of them on there, so I got a little bit of a text. So it's following this up. We're looking forward to turning fall again. And it's rallying, so we're just getting left behind again. Just take the arrows, Land. Just take the arrows. Well, I thought we were taking that arrow to the downside, and then it flipped and went to the arrow to the upside. All right, we just took a short position. I don't know if it's going to continue to fall. So I got my stops in there just in case it doesn't. If it turns and starts to go back up again at this point, well, I just get back out with another small loss. Now I got 2 orders in here. I think I've got 2 orders in here. Am I short 2? Yeah. So we're going to scalp one. It's called scalp. So we just took a profit off. You can see we're back to $15 in profit. Now we're still got one going. So if it starts to run and goes a long ways, well, I got one that's called a trailer. All right. So my trailer is still there. So I've also got a stop that's just going to trail down. So if the market will move, oh, we got stopped out again. But at least our scalp got us back to $10 profit, so we didn't lose any money on we're not down money. Now we just need the market to move again. Well, it'd be nice if I had another one of those big long moves and we could catch it, but now it's just going sideways. It's not trending for us. They decided that was good enough. Now you can come in here and do some fancy stuff, and I know some of you have been looking at fancy stuff. You can look at a 50% retracement or a Fibonacci ruler off of this tool, and you can see right there that market had this nice run from A to B, and it's pulled back right down into what we call the Fibonacci sweet spot. That's between 61.8 and 38.2. And it's just rattling around in there right now. And oftentimes the market will go and do that, and then it hasn't got any direction, hasn't got any footing. Doesn't know whether it's going to be bullish or bearish. So it just kind of rattles around and goes sideways there for a little while after having a big run like that. And then the pullback, and then it just goes sideways. So we kind of learn some of these little techniques. And so, but for the most part, we're just kind of waiting for a market to get excited again like that, and then wait for a setup. So we as traders, our biggest job, the hardest thing we have to do is not trade. The hardest thing we have to do is when a market's going sideways, don't trade, because that's where you get cut to death like we've just done here. All right. The problem is you're like, yeah, but Land, one of these is going to take off and it's going to go to the moon or it's going to fall to the floor. And you're right. One of them will. And you're going to feel like you missed it. But that's okay. You're going to miss that one. All right. That's called our A1. We label these drives. We call them A drives, B drives, C drives. We like to do that kind of stuff too. All right. So we're going to look at A drives, B drives, and C drives in this class. It's a little bit beyond the scope of today's class, so you're going to want to make sure to come back later, and we'll go into some deeper stuff. But right now, we're just looking at green to red, red to green, green to red, red to green. That's all we're doing. We got these little arrows here that can kind of help us, and we're looking at the volume. Volume just tells us how many people are trading. That's all it is, okay? So you get little green volume, that means lots of people were buying. Then you get red volume, that means lots of people are selling. Okay, so the bigger the bar, that means more people are selling. If it's red, the bigger the bar. If it's green, more people are buying. You can see the volume total right up in here. See this little volume thing? I got this right in here. That tells you the volume. All right, how many people are trading per bar? So if you hover over the last bar, well, 85 contracts have traded hands, 90 contracts, 97 contracts, 100 contracts. So we got 100 contracts traded hands on that one bar, and they were mostly green. All right, most of them were green. So they started to buy. But that's the volume's gone way down. Or just the market's kind of died here. Now don't we have a government report coming here in just a minute that everybody's waiting for? I think at 8 o'clock we have business inventory coming in. All right. So in 4 minutes, we got a government report that's going to fire off, and that's going to make the market move again. Now, is it going to make the market go up or down? We don't know. We don't know. We're not here to decide whether government reports are going to be bullish or bearish. You're going to see how many times you come in here and you read that thing and it says, hey, that should have been good news, and it goes down. Or, oh, that's bad news, and it goes up. This time, in this case right here at 6:30 a.m., it was forecast to be 0.2 and it was only 0.1. That was bad news. But yet when the market opened, look at it, took off like a rocket ship. So it's not for us to determine whether news is going to be good enough to make the market move or bad enough to make the market move. All we have to determine is that, hey, there's going to be a big news event and the market's going to move. And we don't care. We're just going to watch our patterns, and we're going to go long or short based on whether it goes up or down. Because remember, we only have a 33% chance of being right. So make sure that when you watch these markets, wait for them to move first. Okay, so it's kind of made a little 4-bar green rally, right? It might continue higher. If you wanted to take a chance, you're going to risk what, 20, 30 bucks to find out if you're right. Oh, we didn't put our order in and it didn't keep 2 bars back. It's just going down again. So it's not really doing anything. We still got like 2 minutes until the bell rings. Not till the bell, but till the report comes out. All right. So what we're really looking for is we're looking for markets to make trends like this. All right. I mentioned the ABC drives. So as a market moves through trends, this is called the A drive, the B drive, and the C drive. All right. So when you get a nice trend, that's what we kind of look for. And each one of those little pullbacks is an opportunity for us to get into the market. And so what we look for is we look for little patterns like this. All right. We're looking for little ABC patterns. This is called a bow tie pattern. Markets have a tendency to go up, come back down, and use the previous high as support. All right. This is called support and resistance. And we're just looking for support and resistance areas. Oh my goodness, look at that market starting to fall. Now, if we could get a little green bar coming back, and I remember how I said sometimes it goes without you, just leaves, and you're just like, oh crap, I missed it. It didn't give us a little 4-bar, a little pullback, and then a drive again. This one, it went up, made us 4 or 5 bars up, and then it just flushed down. That happens sometimes. All right. So now we have a position right here. Watch this. We have a line that we draw from this low straight over like that. There, I'm going to draw it with a trend line tool. Watch the other markets. That's why we have them on the screen so we can see the other time frames. So now it's coming down. It's touching 61.8. That's a Fibonacci number. But that blue line right there is more important. That's called the VWAP. Markets like to come to that VWAP. It's called, think of that VWAP as a rubber band. It's got gravity, okay? And it pulls the market to that rubber band. Market always likes to go back to the rubber band, okay? Man, that was another big long move land missed. All right, so now we're going to look for it to rebound over here and come back to that red line. Why is that red line there? Well, it's only there because of that low point right there. So sometimes that's what markets like to do. They like to go up, they like to come down, and then they like to go back up. And we tie that off. We call that a bow tie. All right. So it's coming down. That doesn't mean it has to do it. It's a tendency. The market has a tendency to do some of these things. So here we are touching the VWAP on the 2-minute chart. Same up here. It's going to be on the range bar 12. That 15-minute chart still kind of shooting all over the place. Okay, so it's bouncing off of the VWAP. Now we'll probably go back up to that red line. We could take a long position right here. Okay, we could get in, put our stop in here, and we're just going to anticipate. If it doesn't, if it turns and makes another one and goes straight down, we could take a short instead because, market could go down, make a little green bars here, and turn and make another fall like that, right? But we're going to look for it to come back up and touch that red line. Oh my goodness, it went right up and almost touched it just like a train on rails. So there we go. So we're going to get out right there, and that's just called a quick scalp. Okay, and that's called a butterfly pattern. All right, that's what we just showed you right here. See that? See how markets have a tendency to go up. They make, right here's this one right here, the Fibonacci bow tie. That was a bearish one. It had the low point here. It went up. It flushed all the way down. This time it went down to the VWAP, turned right around up, came right back to that A point. So that was called a Fibonacci bow tie. Now it's making another little ABC pattern right there. So there we could take a long position if it wants to continue higher. We could get in, take another long position, put our stop in here. We're going to put it right here behind this price bar that it's at. If it doesn't continue, we'll just get right back out. Oh, it just failed on us. I had my stop a little close. We could keep going. Put my stop on the, it really is going to fail. There we go. Okay, go a little bit more, buddy. Don't die on me. So I put it on the yellow dot, and now it's going to just follow the yellow dot. Come on, keep going. Oh, it stopped. So it's starting to go sideways. I'll give it 2 shots. If I take 2 shots, I'm not gonna take more than that. Now we're back down to $5 again. We had a nice scalp there where we went from the VWAP back up to the Fibonacci bow tie, and then we gave it all back as the market started to go sideways again. Them's the breaks. Sometimes you catch a big long one, sometimes you catch a little tiny one, sometimes you get your bait taken. So trading is like fishing, right? Trading is like fishing. Trading is like fishing. There's a lot of waiting and searching for the right fishing hole. Then throw your line in the water and hope for a bite. Sometimes you catch a small fish, sometimes you catch a huge giant fish, and sometimes you lose your bait. It's rare to catch a big fish. More likely, you're going to catch a lot of small ones. But a lot of small fish those are good eating too. All right. So trading is like fishing. All right. This market's starting to rally a little bit here. It's trying to take off. See if we can't get a little, wait for it to go. There's an arrow right there. Wait for it to go. Give us a couple little bars back. See if it won't go again. Now we got the government report just came in. All right. So we can go look at that and see what the government's saying. We get a government report in here. Business inventory came in. Forecast was 0.2. Actual was 0.3. That's good news, right? So we're going to come in here and say the market should stay bullish on this thing. So there it goes, starting to go up. Let's see if it'll give us a little pullback, give us an opportunity to get into the next long run. All right. Now, doesn't mean it can't just take off and go without us, and then we leave us behind crying. We need a little bit of a pullback. We need something to give us the opportunity to get in. Now, there's a lower high right there. So we're going to drag our order in there and drop that in. We're going to do scalp and trail. So there's my scalp. There's my trail. Now it needs to turn around and go back up. Let's get rid of some of these drawing tools. If it just turns and flushes, well, we're not in the market. We're just trailing with an open position to get us in if it turns and starts to go back up again. It doesn't look too excited to go back up, though, does it? Come on, you rotten little thing. Don't just die on us now. Well, down it comes. How far are you going to let it go before you change your mind and say it's not going up? Ooh, look at it go. Flushing down. We got a down arrow. Now we can use another tool. I'm going to flip on another tool, another indicator to kind of give you a little help here. We're in a down arrow. So now we're down to bearish again. We just get rid of these. It doesn't look like it wants to go up. Or it might. We could just leave it on there, see how far down it wants to go before it turns and wants to go back up. We're going to turn on the moving averages, all right? So we got some moving average lines on here. And they come on and they help us know where areas of support and resistance are as well. So that's that green line we just turned on right there. And we got another one in there. There's a yellow one. And there's a couple more in here. You can see we got 4 of them. But they're kind of far out. So we'll see. We're trading a little tiny time frame here. This is a range bar 6. Those are 6 minimum moves. That's what that means, all right? There's no time involved. It's just boy, look at the market flush now. So it did that little flushy thing. It went up and then flushed again, just like it did on us last time, where it made that little false move to the upside and then flushed down. All right. Exit those out. Got left behind again. Line got left behind again. Those are hard little patterns because it goes up and you think it's going to go like this, and then it goes up and then just boom, flushes like a toilet, and you miss that whole big rundown because you were thinking it was going to go up. Okay, if we'd have had left our position on, we'd be long and short. We'd have got stopped out right there already. We'd already been in a bad situation. It's a good thing we pulled that off. So if we're going to take a long position, we want to wait for it to go up a little bit and then give us that little opportunity to get in. We don't want to try and take sometimes you'll take the reversals and they'll pay off, and that's okay. But sometimes reversals are hard because the market has a tendency to do this little jig and jog down here, right? It'll do this little thing that stops you out. So wait for it to, if you're going to take a reversal, wait for it to actually prove it's actually going to go up. Pretty good move. and then do one of these before you take the reversal, because this could be a down, a little green, and then a big down, right? And that's generally what we look for, continuation of the trend. So then we would drop an order in here and another one here in anticipation that the market falls. So we get this little small pattern. Now we need it to fall. So we're in short. We got very tight stops, because if it just turns and starts to go back up again, we don't want to take a big loss. We just get out. Land's fishing for a little bit bigger fish. I want a little bit bigger fish. All right. Oh, we got stopped out on one. That was good. That was a profit taker. So we just took some money off the table. That was called our scalp. Now we're letting our trail go. So we scalped out $45, it looks like, because we were at $5. Now we're at $50. Okay, we just need that bugger to fall. Come on, baby. Rock and roll. I'm going to set that to trail down on those little yellow dots. I'm going to come in here, and all I have to do is just say trail on the ATR. Hit OK, and that trailing stop now is going to stick to those little yellow dots. See those little yellow dots? That's my trailing stop. That's why it's called the stop factor of the average true range. So it's going to trail down. If you get a nice move like that, it'll just trail down behind there on those little yellow dots. If the market turns around and hits that little yellow dot, well, it's going to stop me out, stop my losses, take my profits at this point because I'm in the money, $25. There we go. We just got stopped out. Now we're up $70. Well, that kind of sucked. I wanted a bigger move than that, but it came back and stopped us out. It hit our little yellow dot. So now we have to sit and wait for another setup. Now, how much money am I having to have in my account to do this? Well, this is the mini, and so I have to open my account with $5,000. All right. But if I went down to what we call the micro mini, which is 10 times smaller, think about that, 10 times smaller. There's another chart. You just open up a Dow. It's called the micro mini chart. You open it up, and then when you trade on it, if the market would have gone that far, instead of been $200, it'd been $21. But so if you want to trade like that, you can open up your account with $2,000, and you can still trade. You trade on a micro mini account, and you would have made $21 instead of $200. But of course, you'd have lost. If you'd have stayed in that long, you'd have lost $21 instead of $200. So it cuts both ways. The knife goes both ways. It's a two-sided blade here. If you can make money fast, you can lose money fast, which is why we just want to get out if we're wrong, because it can be a lot of money. All right. But it's just a percentage gain. So if you go over and you start trading on the micro mini, we could do that. Let's go look at it just for fun. We'll come in here. I'm going to show you. I've got it all set up in my portfolios. So I'm going to come into the micro mini. I think I got the micro mini in here. Mini micro Dow. There's the micro mini Dow. It's going to roll those charts for us. There it is. There's the 1 minute chart on the micro mini Dow. Here's the 2 minute chart on the micro mini Dow. So let's draw some dollar calculators in here. All right. If we'd have got in right here, again, starts to rally, pull back, up, that would have been a $55 move. $55. How much money would I have had to have in my account? $75. So that's why you can open up with a $2,000 account. You only have to have $75 to put one position on, and you'd have made $55 on that move. All right. Now, the commissions and fees for trading on the micro mini are not 10 times smaller, but the market is 10 times smaller. The commissions and fees are a lot smaller than the mini, but they're not 10 times smaller. So you have to take that into consideration as well. In the demo account doesn't use commissions and fees. It just says everything's zero. So you always want to make sure you're taking commissions and fees into consideration when you're trading in the demo account and you're practicing. And so here in this class, because I'm a teacher at the university, right? Come in here. Who is Lan Turner? I'm a former instructor at the Chicago Mercantile Exchange and the Board of Trade's Education Centers. And so I like to trade in the futures market. I used to teach there. All right. So I'm currently an instructor of finance at Utah Tech University. And so I come on here to this YouTube this YouTube channel, and this is where I teach my students how to trade. And so I teach them to trade in the futures market, because you can start with a very small account. There's no pattern day trading rules, and you can, learn to trade, and you can get your feet wet. You can start with a tiny little account. You can start with a $2,000 account, and you can trade the micro minis if you want. If you want to go in and you want to trade the mini accounts, go ahead, trade the minis. They're 10 times bigger. All right. So you can make 10 times as much money, but there's also 10 times as much risk. So that's why we're very careful and we're cautious, right? Be very careful, cautious. If you get in and the market doesn't just immediately move in your favor, just get right back out. Take a small loss. You got 7 hours in here to sit here and trade. Don't feel like you have to trade all the time. Don't feel like you have to take every little move. Just wait for the market to do something that you're really comfortable with, you're really confident, and then put it in on that one because you can make a lot of money in just a short amount of time. I mean, people, you'll work all day long to make $100. Some people go to the gas station and work all day long. I used to work at the gas station. I use gas station as a example because that's where I worked. When I grew up, I was a young kid. My dad owned gas stations. He had a whole bunch of them. And I used to run a gas station. That's what my job was. I worked at a gas station. So if a guy who works at a gas station can pick up his boots and make this work, then there's no reason you can't too. All right. I'm just a gas station kid. I was the kid that would come out. We used to have full service gas stations. You remember those? You used to come out, put air in your tires, and we used to come out, check your oil for you. We used to come out, wash your windows for you. Those are the good old days, right? So this market's still falling, isn't it? If you think it's going to continue down here, we're in the micro mini. You could come in and you could say, well, I think it's going to continue to fall. All right, well, take a short position. We're going to sell one. Put your stop in there. I'm going to just put it real close. One price bar back. If it starts making higher highs again, we're going to get out. Remember, the definition of an uptrend is higher highs and higher lows. Definition of a downtrend is lower highs and lower lows. If it's making lower highs and lower lows and you want to get in, see if it's going to go. But then if it doesn't make lower highs and lower lows, just get right back out again because it's not making a downtrend. Okay, it's not continuing in the downtrend. So here we are. You see, it's not a big risk here. And they don't get mad at us for trading a million times in one day. They don't care. They don't care. We're not in New York where they get mad at you for trading too often. Don't trade so much. Who wants to be a day trader in a place where you can't trade? And everybody's always, I got to go over and day trade in the stock market. No, you don't. Stop thinking that unless you got lots and lots of money. Big accounts. Okay, it's coming back in. It stopped going down. Why did land get in at the bottom of the trade? Well, because we were talking about it. Let's see if it's not going to continue. Okay, it's slowed way down, hasn't it? Now, this is a 1 minute chart. This isn't the range bar 6. Range bar 6 chart will go a little bit faster. Do you have range bar 6 charts on the micro minis? You certainly do. Let's go pull one up. Come in here, range bar 6. Now you can change it. You don't have to be range bar 6. You can be any time of range bar you want. You can be range bar 1, range bar 2, range bar 3, range bar 4. Range bar just means that how many minimum moves. The market can only move. The smallest incremental move is called a tick, right? So 1 tick, 2 ticks, 3 ticks. Well, this is 6 ticks. So each bar is representative of 6 ticks. All right. So we got that set. You can see over here on the Dow, that's a 1 minute move. Over here, this is the range bar 6. So you can see the difference between the two. Now we're trailing. We told it to trail, or we didn't tell it to trail, did we? Let's come in here and we'll go trail. Let's just go trail 1 price bar back. Price bar's back. We'll just follow one 1 minute price bar back. All right. Now you look over here on the range bar. That's what that looks like. 1 price bar back on a 1 minute chart looks like that on the range bar. And it's trailing 1 minute back. On the range bar, you're looking at it and saying, it's coming back. Put it to break even, land. Put it to break even. It might come back and stop you out. Why would you let it lose money? Well, because you're holding it 1 price bar back on a 1 minute chart. That's what that looks like on a range bar chart. Can you make those candlesticks? You can. You right click, say price bar type, candles, just like that. Now you got little candles over here. Those are not Heikin-Ashis though. Yeah, well, that's true. Let's make them Heikin-Ashis. There's a Heikin-Ashi now. All right, there you go. Now you got your Heikin-Ashi. It's going to come back and stop us out with a loss. It could do. Making a little bow tie, isn't it? A little Fibonacci bow tie, just like we talked about. Up, down, came back, come all the way back, tied it off with a bow tie. There's your bow tie. Got stopped out. How much did we lose when we got stopped out on that one? Let's go look and see. In our accounting, got our closed window. We just lost $4.50. Now there was a commission in there, which probably been $1 or something. So we probably lost $3, $4, $5. You got to take your commission into consideration. Now your commission, I don't know what your commission is going to be. So Generally, everybody starts out at the same rate, and then the more you trade, your commission goes down. You get smaller commissions the more you trade. They reward you for trading more. If you just trade once or twice a day or once or twice a week or once a month, you pay a little bit higher commission. It's usually pennies, but this can be pennies count. So what are you going to do? What are you going to do? Market's kind of being funny now, isn't it? Just kind of not really being very nice, strong trend. We get a little bit of a uptrend here. It might turn and start to fall again here on the 1 minute chart. See how it looks over here? If you think it's going to take a short position, you could do it over here. Take another short. See if it wants to fall one more time down. Market's really slowed down from what it was this morning. All right. So there you go. We talked about day trading in the futures market for you. Oh, you couldn't see those little prices down there because I was in the way. Let me get up there. There you go. You see, I lost $4.50. You have to take commissions and fees. Again, we're in the demo account because I'm giving a demonstration, but there's no fees in the demo account. So you have to take those into consideration. You can talk to your broker when you open your account. He'll tell you what your commissions and fees are. All right. Look, I think I got this one here. Look at that. We can put me in the middle nowadays. All right, guys. I'm going to come over and say hello to a few people. We like to always say hi to some people who are in the class. So there is Mark Boucher coming in first place this morning. Mark getting up and out of bed and in front of his computer first thing in the morning. It's nice to see you, Mark. Gary Thomas coming in at second place. Bruce R. coming in at number 3. It's nice to see you guys out. Kirk saying hello. Good morning. We've also got Michael Bruce coming in. Michael Bruce, nice to see you. Kim Moss. Hello, Kim. It's great to see you in class. Michael Bruce says, Lan, I find what? Let's get a little comment here. Let's see what Michael Bruce says. I find that when I use the Fibonacci ruler, I get focused thinking that the market will move in one direction when in fact it can go in 3 directions. When you use the Fibonacci ruler and it gets back into the Fibonacci sweet spot, that's a neutral zone, right, Michael Bruce? So it gets into the neutral zone. And when it's starting to go sideways through the Fibonacci sweet spot or in the neutral zone, well, you don't know where it's going to go. That's why it's going sideways. It's a neutral zone, and the market can either break higher, it can continue to go sideways, or it can go down out of that. Usually we want to see markets get into extreme levels of high points or extreme levels of low points, and then we look for the reversal at that point. When a market's neutral, that's why we have the stochastics indicator pulled on here. Let me bring this full screen. We'll give this one little lesson before I let you go. See, I like to use the stochastic. I'm going to turn the DMI off. We'll talk about that another time. But when the market gets up into this region here, this is called overbought. And when it's down in this region here, it's called oversold. So when a market's moving kind of sideways, you'll see that when it gets up in this overbought region, this is an extreme to the high. We'll expect it to roll and go down. When it's down here in the bottom side, this is a low. We expect it to roll and go back up. Now, this is in an overall downtrend, and you can see that the moving averages are pointing down. So we don't really kind of expect when it goes up to go all the way back up and create new highs unless it's going to change direction. So these pullbacks, from these lows in a downtrend are going to be more shallow, and then the drop should be bigger, shallow, bigger drop. So that's your counter trend, right? Counter trend. Now we're getting kind of a reversal here. Now it's starting to try to reverse and come back up a little bit. So you're getting a little bit higher pullback on that stochastics indicator. Now the problem with stochastics, and I think we got a good example here, is that it can get up here into this upper region like this, and it can just stay there when a market starts to trend. It does pretty good when markets are kind of going sideways like this. But when a market starts to really trend, let's look back here. See how it came in here? During this really strong trend this morning, it went up into this upper region, and then it kept dropping, but the market really didn't drop that much, right? It's just all these little counter trends. And it just stayed up there during this entire uptrend. So keep that in mind, that the stochastics indicator can get up into that upper region and stay there during an entire uptrend. But it does give you these little pullbacks here. And so the little pullbacks are shallow as they come in, and it kind of reflects what's going on in the market. And then it turns and starts to rally once again and goes to the next level. So we do have that, but then you can see how it kind of corresponds and shows you. And it gets way down here in this oversold region. and that's an extreme, and those are where you want to start looking for rebounds, turnarounds, and markets going in the other direction. All right, so that's how we read stochastics, and that's how that's on there. That's why that's on there. It kind of helps you with that movement of the market as the market's moving through price and time. All right, a little bit sideways. See where it got a little ugly in here? Where it just kind of went sideways after that. That was that sideways market Michael Bruce was talking about. It went into the Fibonacci sweet spot. Well, look what the stochastics did. It kind of just stayed out in this middle range. Didn't really, it kind of tried to go up in this little top range, didn't it, right here? And then it went down into the lower range right here. It's all relative. It's based on percentages. So it comes in here, and you can see that it goes in. Try it right up in here. You can see a little bit of a peak right up in here. But that's what stochastics does. It kind of tries to help you identify where you're going to get a rebound and a turnaround in the market. So kind of keep that in as a little feather in your cap. It's not perfect, but it works pretty darn good. And so it's something I like to have on my screen, and it's one of my favorite indicators, actually. So just realize it's not perfect, but it's a pretty good help. All right. Okay, guys, I have a quick Sunday school lesson for you, and then we'll let you go for the day. Scale in and out of positions. Take profits as they come. Take profits as the market hits key support and resistance points. Buy the valleys and sell the rallies in an uptrend. Sell the rallies and buy the valleys in a downtrend. All right. So that's kind of what we're talking about here with the stochastics indicator. We know we're in a valley when the stochastics indicator is very low down in that bottom region. We know that we're up in a rally when the stochastic gets way up into that upper region. So buy the valleys and sell the rallies, or vice versa. You can sell the rallies and buy the valleys. All right. So let's see what else. Michael Bruce has another. I have a question. What if one day I decide to teach some person how to trade? Would you sue me if you used your class materials? Heck no. Everything I give here is free. Anything you can get from me, you can have. The only thing you have to pay for are things that you paid for. And then I don't care. Use all my stuff. You want to open up a YouTube channel and start showing people how you trade, and you want my help, I'll help you. I'll help you start a YouTube channel. I'll give you all my slides. Whatever you want. I'm not that guy. I'm not worried about it. I just do this for fun. You guys can come along and join me and have fun, or you can go start your own YouTube channel if you want to. I'll come to your YouTube channel. I'll come and be a guest on your YouTube channel, Michael Bruce, and I'll give you all my slides. You can use all my stuff. All right. And then I'll come on your YouTube channel. You can come on my YouTube channel. How's that? I'm not that guy. You can use all my stuff. Anything I have, it's yours. Use it. All my slides, anything. I don't copyright anything to the point of where you get sued. Now, if you start giving away the software, but that's going to be really hard. You got to kind of own the software to but you can use it. You can take snapshots of it. You can create your own magazine, your own articles, take pictures of the track and trade software. You can put those, all publish them in your articles. You won't get in trouble for anything like that. Anything, everything's free. It's all free. We don't care. Go do it to your heart's content. All right. All right. Which brokerage firm do you deal with? With Canadians. Well, your dear, sweet, very kind and loving government won't let you trade in America. They said that's too dangerous for you, and that's not a decision you're allowed to make on your own. So your government said, no trading for you. So there are very few companies that are American companies that are registered in Canada too. So there are no companies that use track and trade that are registered in Canada for trading. So you're kind of stuck with like one or two companies that you can trade through. American companies. You have to trade the U.S. firm. Canada cracked down on that really hard. They don't want you to trade in America. So one way you can do it is you can open up a business in Nevada. Go to Nevada, open up a Nevada S corporation, and then you can open up your account with that S corp from Nevada. That's the only way you get around it. Okay, so you have to have a U.S. presence, and then that U.S. presence can actually do it. So you can't just say, well, I'm a Canadian member. I live in Canada and I want to trade the U.S. markets. Canada says, no can do. You're not allowed. So there's a couple of companies that are registered up in Canada, And but most of them you have to just trade the Canadian stock market. They don't want you down here trading the American stock market, so they put a big kibosh on that. Right. So and I apologize for that. I'm sorry, I can't change that rule. I wish I could. There's a lot of traders. We have actually a lot of people who come and join our YouTube channel. A lot of people buy Track and Trade and want to trade in the stock market, the futures market, and the Canadian not allowed to open up accounts. So they stop them from doing that. Just the way it is. All right, guys. I am going to let you go for the morning. I wanted to announce something for those of you guys who are still here. I think we're going to change the schedule. Michael Bruce says no problem for people in Jamaica. So there you go. Mark Boucher just moved to Jamaica with Michael Bruce, and you can trade to your heart's content. All right. So I think we're going to change the schedule. What do you guys think of this idea? It's the summertime, and I want to do some. I like to do some different kinds of trading in the morning myself, and I don't get to do a lot of it. I've been giving up a lot of my own trading because I come and do these classes. So a couple of days a week, I'd like to trade my own money in the mornings, and then I would like to do classes in the afternoon during power hour. So what if we had some afternoon classes? Because a lot of people don't want to get up first thing in the morning and come and join us either. They're busy. They got to work. They're like me, want to sleep in. Maybe that's what I really want to do. I don't want to trade. I want to sleep in. No, I like to get up and trade. But I was thinking that 2 days a week we could do power hour in the afternoon and kind of change things up a little bit. So we'll do power hour in the afternoon for a couple hours, and then or an hour, and then we'll do. I'm trying to think. The whole thing is I'm trying to think maybe I'll take Fridays off during the summertime. Wintertime, when we're back to doing in the university, we could do all 5 days. But summertime, and the 4th of July, I'm going to have to take a couple of weeks off anyway. I got a friend coming over from New Zealand. Anybody here from New Zealand? I got a friend who's coming over from New Zealand. He's going to be here for a couple of weeks, so I'm not going to be teaching classes in July, around the 4th of July timeframe. But I'm thinking of doing power hour. So we'll do a couple of days of power. So we'll do Monday mornings, because Monday mornings are always good. And then we do Tuesday, we do power hour in the afternoon. Then Wednesday, we do the morning again. Thursday, we do power hour. And then Friday, I may take Friday off. Not trade Friday during the rest of the summer. And then start back up doing Fridays again in like October. But I may do Fridays too. So make sure that you subscribe to the channel if you haven't yet. Ring the little bell so that you get notified when I do these, because if I start changing up the schedule, you're going to want to know when the new schedule is and when I'm going to be doing classes, when I'm not, so you can join us. Make sure you subscribe, hit the little bell so that sends you a notice, and then hit the little thumbs up if you like this class and if you learned anything today and if you thought that was fun and you want to come over and trade in the futures market with us. For those of you who haven't done that yet, go open up your account with Track and Trade and join the club. And we'll see you over here on, let's see, tomorrow is Wednesday. Today is Tuesday. So we'll be back here tomorrow morning. And then on Thursday, I'll do my first day of power hour. How's that sound? All right, guys. Tomorrow morning, we'll see you back here, bright and shiny, and we'll do it again. See you tomorrow.